from University of Malaya are here to share with you our investment view on Sunway. I'm Kaylin. I will start with the business overview and recommendation, followed by my colleague Ifti, who will discuss on financial analysis, followed by Wenhao on the valuation and investment risk. Sunway is a diversified portfolio which with a growing assets of retail, hotel, and office. Its key retail segment is the key contributor that contribute to 70% of its total net property income. It is also geographically diversified across 4 states. The stock price shows that there is a reason steady increasing in the share price and also steady distribution yield. In general, a general outlook shows that there is a surge in the retail and office space. However, there is actually opportunity for those assets that are well positioned and well managed. For the hotel segment, Malaysia's position as an emerging international MICE hub acts as a solid growth driver for the corporate guests. Meanwhile, Visit Malaysia Year 2014, which aims to attract 28 million tourists, will be the catalyst for the retail and hotel sectors. In short, there is a premium opportunity for those assets which are well positioned and well managed, and this is where Sunway comes in. Ladies and gentlemen, today we would like to initiate a buy call with a target price of 1.57 ringgit with a potential upside of 37% from the current price of 1.24 ringgit. Our buy call is based on 3 unique aspects of Sunway. First, Sunway is the one and only integrated township in Malaysia. Second, it enjoys 2-digit rental reversion on its retail assets. And lastly, it will replicate its success to the 3-in-1 new development Sunway Putra Place. Ladies and gentlemen, would it be good to have a dream house? Greater still, to be in a dream neighborhood. Imagine a place where you can learn, live, work, play and shop. This is where we start our first buy call, which is one integrated township concept. It is an all-in-one asset where you can find nowhere but Sunway Resort City, Malaysia's first and only fully integrated township in Malaysia. 4 of these assets are managed by Sunway. Assets in this growing township is well connected internally and externally through its improved connectivity, and this will create a larger synergy that brings more footfall into the area. This translates into long-term sustainability, which also proved by the assets which will be injected into the REIT. This will further enhance the growth potential of Sunway REIT. Second is the rental reversion, 2-digit rental reversion enjoyed by the retail segment of Sunway REIT. These assets have enjoyed 2-digit rental reversion from the past few years, and it will continue to enjoy this premium. Therefore, we'll continue to see increase in the rental income. Last but not least, our third buy call is the 3-in-1 new development Sunway Putra Place, comprises hotel, office, and retail. It aims to develop as a lifestyle urban chic mall that attracts middle and upper middle income shoppers through its excellent connectivity. The management expectation of ROI yield of 8% is indeed a new growth impetus. We believe that this project is viable because the management has the expertise to replicate its success of integrated township into SPP, the new jewel. With the 3 unique buy points I mentioned, we now proceed to the financial analysis.
Nothing tells a story better than numbers for an investment. I am Iftikhar and I will continue with the financial analysis. We do not expect a repeat of the exponential growth in the first 3 years of its operation that started on a low base. We project a 6% growth in earnings, which will be in turn derived at 4% growth in dividend per unit. In 2014 and 2015, we expect a fall in earnings because of cost hike. However, in 2016, the earnings will grow exponentially because of SPP. Next, in the waterfall chart, we see how earnings increase from FY13 to FY16. There are 3 main contributors, with organic growth and SPP, the positive, and cost hike, the negatives. The organic growth will be boosted by strong rental reversion from its retail segment and office segment, and its occupancy for its hotel segments. We are confident with the management expectation that the Sunway Pyramid Shopping Mall will continue to enjoy 2-digit rental reversion, and the medical center will provide a steady earnings growth. With this, the occupancy level of the hotels will also be constant with strong promotional activities. The next is SPP. SPP is a 3-in-1 combined development which will boost the earnings by a further 28 million. In SPP, the SPM, we project 80% conservative of occupancy rate with 480,000 square feet, which equals to around 8 football fields. This will create synergy for the 2 other office and hotel segments over there. Next, we move on to the cost hikes. The cost hike of 28 million will come from increase in financing costs, electricity tariff, and also KL assessment rates. Due to the diversified portfolio, the KL assessment rate hike will be diluted, and its energy saving initiative will dilute the effects of the increase in electricity tariff. In sum, despite the danger of cost hike, we are confident that the organic growth and the SPP will push forward in the future growth. With 6% earnings, it will, and a 95% payout ratio, we get a 4% dividend per unit growth. We transfer this 4% into our daily valuation.
Warren Buffett once said, "Price is what you pay, value is what you get." That said, allow me to present to you Sunway REIT's valuation. We consider 2 popular REITs valuation methods, namely discounted dividend model and PE multiple. DDM incorporates the company's long-term growth potential, while PE multiple is a good proxy for market expectation. First, DDM is a suitable method because of the company's near full distribution payout policy. We assume a stable distribution growth rate of 4%. We also estimate its cost of equity at 8.6% based on the CAPM model. Our DDM-based valuation suggests a target price of 1.75 ringgit. The next slide shows the computation of our DDM valuation. Moving on to the PE multiple approach. We consider both justified PE and peers PE to calculate our target price. Justified PE is based on the future growth of earnings per unit, while peers PE is the weighted average ratio of comparable peers in the Malaysia REIT market. We then combine the 2 multiples, resulting in a target price of 1.38 ringgit. Finally, we took an average of both valuation methods to obtain a fair price of 1.57 ringgit. Ladies and gentlemen, allow me to show you what can potentially go wrong with our recommendation. We classify our risks on the basis of their impacts and likelihood, and we focus on the risks in the upper half section. First, the Sunway Putra Mall project may be delayed due to slower renovation work or insufficient tenants. Our sensitivity analysis shows that every 1 month delay will reduce earnings by 1.5 million ringgit. Second, lower occupancy rate than expected in the retail segment, where every 1 percentage point drop in the occupancy rate will result in an earnings drop of 2.7 million ringgit. And third, financing cost increase due to higher loan rates, where every 1 percentage point increase in the financing cost will reduce earnings by 3.4 million ringgit. However, our investment risks are minimal. This is due to the company's good management and good locations. To change our buy call, the earnings must go down by 22%. It will take either the rental rate to go down by 17% or the occupancy rate to go down by 16 percentage points. Chances of either that event happening are remote because of the company's good track record of occupancy rate and rental reversion. To wrap up, let's recap our 3 buy points, namely 1 integrated township, 2-digit rental reversion, and 3-in-1 new development. This uniqueness will give Sunway a competitive advantage, translating into a sustainable growth. And our conservative forecast further provides a solid ground for our buy recommendation. Thank you.